Welcome to You and Your Money. Today's episode features Jonathan Mathews, Associate Vice President, Wealth Advisor at WHZ Strategic Wealth Advisors.
Let's start with the basics. When does the 2026 tax season officially begin?
So actually that's one of the uncertainties this year. Typically, the IRS begins accepting tax returns in late January. However, due to the recent government shutdown, the significant new tax legislation that was passed this last year, there's some concern that the IRS may need additional time to update their systems and forms. The filing deadline does remain April 15th, 2026, but many may see a slight delay when they start and when you can actually submit your returns.
So even if there's a delayed start, the deadline doesn't change, does it?
That is absolutely correct, right? The IRS is not going to budge on the deadline for that. April 15th, 2026 is still the date to have your taxes filed or to request an extension. The good news is that you can have you can still prepare the returns early using tax software, working with a tax professional. Even though the IRS hasn't officially opened up for submissions yet, you could still do that. The completed returns will be held securely and automatically submitted once the IRS does begin accepting those returns.
Would this late start, proposed late start anyway, be bad news for people who want to get their refund back as soon as possible?
It could. It could delay that a little bit. The IRS has been impacted the same as many other government organizations with some personnel issues, so it's going to be an interesting tax season for sure.
Early preparation, still the way to go. We've talked a lot this year about the Big Beautiful Bill Act. Can you remind our listeners exactly what that is and how it will affect regular taxpayers?
Great question, Wayne. The Big Beautiful Bill Act, or OBBA, as it's been called, was passed by Congress in July of this year, and it made several important changes to the tax code. The biggest news is that it made permanent many of the provisions that the Tax Cuts and Jobs Act of 2017 were set to expire at the end of 2025. This means the tax rates aren't going up for most people, which is good news for many of the listeners.
Well, that's good stuff. So we'll see where that has an effect on the 2026 taxes. What about the standard deduction? I know a lot of people rely on that.
Yep, there's some more good news there. The standard deduction is actually increasing for 2026 due to inflation adjustments, about 2.7% across the board. So for married couples filing jointly, the standard deduction rises to $32,200. For single taxpayers, it goes up to $16,100. And for heads of households, it's $24,150.
I've heard there's something new this year for seniors. Can you explain that?
Yeah, that's actually one of the most significant changes of the OBBA. Taxpayers age 65 and older now get to claim an additional $6,000 deduction, whether they itemize or take the standard deduction. This is actually over and above the existing additional standard deduction for seniors, which is the $2,050 for single and $1,650 for joint filers. So the new $6,000 deduction does phase out for many higher earners, starting at $75,000 for single filers and $150 for married couples filing jointly, but it is still a great benefit for those that are 65 and older.
So for a retired couple, that could mean significant tax savings.
Absolutely, and that's what it was targeted for, was folks that were done working, so their income was probably a bit lower, but they wanted to get some deductions for them. So for many retirees, this could reduce their taxable income by about $12,000 if both spouses are 65 or older and qualify. That's a pretty meaningful tax break that can help retirement dollars stretch further.
And as you talked earlier, a lot of people do like to file as early as they can so they can get a refund back. But there's something I've heard about regarding refunds this year that people should know about.
Yeah, that's an important change. Starting with 2026 tax season, the IRS did eliminate paper refund checks entirely, so no more checks getting mailed out. All refunds will be issued electronically via direct deposit. This means it's absolutely critical for you to have an active bank account and provide account information when you file your return, which I know might be frustrating or even challenging for some folks. A lot of people still do receive those checks by mail.
Jonathan, let me talk about a personal feeling I have about taxes. You know, who likes them? Nobody. But I would rather pay the IRS in April or February, March, April, whenever it is, rather than get a refund. The reason is that if you get a refund, that meant the government held your money for anywhere from 12 to 16 months with no interest. I'd rather have my money to spend, maybe get some interest on it, and then pay the piper when it comes due. Do you hear people talking about that a lot?
Yeah, that's a great point, Wayne. Is we tell people that you should really try to net out about even with taxes, right? You don't typically want a big return, but you also don't want to owe a lot come tax time. What we tell people is that even if you're getting a big return, that's not necessarily the best use of your money. We joke around and sometimes call it a free loan to Uncle Sam.
Let's talk about some other changes that might affect listeners. What about families with children?
The child tax credit is another one that does remain really important to folks with kids. At $2,000 per qualifying child, the refundable portion is $1,700. These amounts stay stable from last year. The earned income tax credit is another one, and that benefits lower to moderate income workers. It actually did increase a little bit in 2026, again, due to some inflation. For taxpayers with 3 or more qualifying children, the maximum credit's a little over $8,000.
What about health savings accounts and flexible spending accounts? A lot of people use those.
Yep, that would be a whole other topic for another day. I think the HSAs are a great vehicle. The health flexible savings accounts, or FSAs, can contribute. The limits there increase from $3,400 for 2026, and if your plan allows it, you can actually carry up to $6,800 into the next year. For HSAs, which are paired with high deductible health plans, so you've got to have a high deductible health plan first, and then you're eligible for the HSA. That contribution limit rises to $4,400 for individual coverage and $8,750 for family coverage. These accounts offer fantastic tax benefits. Their contributions are tax deductible, money grows tax-free, and withdrawals are qualified for medical expenses are also tax-free. So we call that a triple tax savings.
So people should definitely be taking advantage of those if they are available and appropriate.
Absolutely. They're a powerful tool for managing healthcare costs while reducing your tax bill. Not many things give you a double edge like that. So as healthcare costs continue to rise, having these tax advantage accounts become even more valuable.
We're talking about the 2026 tax season with Jonathan Mathews from WHZ Strategic Wealth Advisors. Let's talk about business owners and self-employed folks. What should they be aware of?
That's another great one. We at WHZ work with a lot of business owners. Business owners have some great news this year. The qualified business income deduction, that's a 20% reduction for pass-through business income, and it was actually made permanent through the OBBA. This deduction allows owners of sole props, sole proprietorships, partnerships, LLCs, and even S-corps to deduct up to 20% of their qualified business income. There are some phase-out income limitations, but this is still a really significant tax benefit for business owners.
Let's talk about estate planning, and I guess there are some concerns about estate tax exemptions.
Yeah, that was a particularly important one for the high net worth families. That was what was the shadow that was looming over folks was the Tax Cut and Jobs Act was going to be closing out that ability for high net worth earners to have this benefit. So the estate tax exemption for 2026 is approximately $15 million per individual. That's actually higher than what folks had feared it was going to be. This is up from $14 million in 2025 due to inflation adjustments. So if you're in that 15 million plus tax bracket, you should be grateful. But there are some critical notes to think about there where the OBBA did extend many of the provisions. That estate tax exemption wasn't among them. Without further legislation action there, we could see the exemption potentially decrease in future years. So through probably the Trump administration, we wouldn't expect change, but then it's going to be up in the air again after that. So for families with significant wealth, this makes estate planning more urgent than ever. And I think it's safe to say that it's tough to get in with attorneys because they've been very busy working on this.
Well, so what should people be doing now if they have significant estates?
They should be meeting with estate planning attorneys as soon as they can, working with their financial advisors and reviewing their plans. There's strategies like gifting, trusts, and charitable giving that can help reduce estate taxes and the exposure there. The key is to act with the higher exemption amounts while they're still in place. So at WHZ, we do work closely with clients and their attorneys to help develop these comprehensive estate strategies that protect wealth, not just for them, but for future generations as well.
4 weeks from today is 2026. So as 2025 winds down, What should I be doing? What should people be doing right now to minimize the 2026 tax liability?
Great question. And you're right. We are running out of time. I feel like basically around Thanksgiving onward, the weeks just fly by. There's several smart moves that you can make before December 31st. The first would be to max out your retirement contributions if you haven't already. So that's your 401k, IRA, the health savings account we just talked about. The contributions there reduce your taxable income for the year. Secondly, you can consider tax loss harvesting. The good news is that markets have done well. There's probably not a lot of opportunities for tax loss harvesting, but if you have investments that are down, selling them can offset the gains that people have realized this year. And then thirdly, if you're charitably inclined, and this is a great time of the year to do that, close to the itemized deduction threshold, you can bunch your donations in 2025 to exceed that standard deduction limit that we talked about earlier.
What about investment-related planning?
Timing is important there. Review your portfolio for any of the capital gains distributions. Those should be, you're probably getting notifications from that if you've got accounts that kick off these gains. Consider whether to defer income or accelerate deductions based on the situation. So it's going to be unique for each individual. Age also is a factor. If you're over 73, don't forget you have required minimum distributions from retirement accounts, and missing those triggers a pretty hefty penalty. If you haven't used your FSA, that flexible spending account balance, that typically does need to be spent down. It's a use or lose, unlike the HSA. And it's a great time to review your tax holdings as well to avoid any of those April surprises.
And I'll bet you get this question a lot. What about itemizing versus taking the standard deduction? How do people know which one is better?
That is a great question. We get that a lot. It's gotten a little bit easier, I would say, with some of this more recent legislation, but it is a critical decision. The higher standard deduction amounts for 2026, most taxpayers will benefit from taking that standard deduction. However, if you itemize deductions and you exceed that standard deduction amount, then the itemization, obviously, it makes sense. You'll want to add things up like mortgage interest, state, local taxes, up to $10,000, charitable contributions, significant medical expenses. We tell people to definitely work with a CPA or an accountant on this to make sure that you have all your ducks in a row. One strategy we often recommend is that bunching of the charitable contributions. If you're close to that itemization threshold, you can make 2 years worth of the charitable contributions in 1 year, and that would then exceed that standard deduction. Then you take the standard deduction the following year. So there's some tax things that you can do that get a little bit more to your benefit for sure.
Great advice. Now, before we wrap up, what's the single most important thing people should do right now to prepare for tax season?
You're putting me on the spot here with the single most important thing. All right, it's all about organization. Get organized now. Don't wait until April when you're stressed and rushed. Set aside an hour this week even before the holidays get really hectic and gather documents, review any of the major financial changes that you had in 2025. And also, if you're expecting a refund, make sure you confirm your banking information is correct and up to date so you get that refund check. If your financial situation is complex, maybe you started a business, maybe you received some money in inheritance, or even if you sold a home or experienced some other major event, scheduling a meeting with a financial advisor and or a tax professional now before we all get swamped in February and March is a great idea.
And that's where WHZ Strategic Wealth Advisors comes in, right?
Right. We teed that up perfectly. Tax planning is key. It's a key component for comprehensive financial planning. At WHZ, we help clients understand how tax changes affect their overall financial picture, and we coordinate with their accountants to ensure tax-efficient strategies.
For more information regarding wealth management and customized financial planning with WHZ Strategic Wealth Advisors, please visit WHZwealth.com. WHZ Strategic Wealth Advisors offer securities and advisory services through Commonwealth Financial Network, member FINRA SIPC, a registered investment advisor. Fixed insurance products and services offered through CES Insurance Agency. They practice at 697 Pomfret Street, Pomfret Center, Connecticut 06259, and 392A Marrow Road, Tolland, Connecticut 06084. They can be reached at 860-928-2341, WHZ Strategic Wealth. Advisors do not provide legal or tax advice. The tenured financial services team strives to support clients in achieving their financial life goals while providing absolute confidence and unwavering partnership for life.